Hello and welcome to our channel. At Pretiorates, our team of seasoned financial analysts, stock traders and professional investors are dedicated to providing fresh insights and diverse perspectives to investors and market enthusiasts. We understand that financial markets can be complex and challenging to navigate. With us, you will not find investment recommendations, but thought-provoking ideas based on our decades of experience. We don't claim to know which way the financial markets will ultimately trend. With my colleagues and our experience, we would like to share with you what the markets are trying to tell us. Thoughts that could help you with your own investment decisions, or provide you with confirmation of your own considerations. In this edition, our Thoughts number 72, we discuss the U.S. stock markets. There are increasing signs that the bears are awakening from their hibernation. Let's take a closer look. Pretiorates Thoughts 72. Not so long ago, in Thoughts 58, we presented Eric Haddock's ominous 17-year cycle, which would see the markets hit rock bottom in November 2024. Each of these cycles has been accompanied by a stock market correction of at least 20%. We are not there yet, but there are increasing signs that this new correction on Wall Street could take on a more significant meaning. But no trend has no counter-movement. This will also be the case with this sell-off. In fact, there are quite a few signs that Wall Street is ready for a strong recovery. Our Smart Investors Action Indicator tracks the behavior of big investors as they significantly influence index movements. By isolating their activities, we create a new index curve. The light blue area highlights the difference from the actual S&P 500. An upward move signals accumulation bullish, while a downward move indicates selling bearish. Red areas mark high-volume phases, which we call exaggerations. The stronger they are, the higher the likelihood of a reversal, especially when a yellow dot appears, signaling a key exaggeration point. The Smart Investors Action Indicator already shows a massive exaggeration, red area, which indicates a high level of emotion. In the meantime, it is even stronger than last August, when the bears last showed their claws. An exaggeration of this magnitude usually results in a counter-reaction. What is still missing is the simultaneous generation of a yellow strong action dot, which would significantly increase the chances of a recovery. The financial markets focus on the future. That is why emotions such as hope and fear are particularly important. New investments are especially promising if you have the courage to enter during pessimistic moments. You should sell investments when optimism is very high. The sentiment indicator for optimism and pessimism has now fallen into negative territory, which is not entirely surprising. This is when the bears have the easiest time. However, if pessimism becomes excessive, it is also when the important lows occur. The indicator has not fallen that far yet. The Nasdaq market, with its many high-tech stocks, is actually a different market, which is why we are still keeping an eye on it. The strong action is even more pronounced here, but a yellow strong action dot is still missing. Therefore, a technical recovery is now possible, but it should remain so. Of course, pessimism has now also taken over on the Nasdaq. The S&P 500 fear indicator has now also fallen into negative territory. However, fear is not yet particularly pronounced. For example, during last August's correction, it was much stronger. Volatility calculates the fluctuations in the market and is expressed using the volatility index VIX. The stronger the fluctuations, the higher the emotions, which makes it an actual fear indicator. The spot index reflects the current situation, while the 6-month view is less affected by daily ups and downs, and thus appears more serene. Wider spreads between the two indicate very interesting signals. Currently, it seems that fear is running a little high and that a counter-movement is likely. The spread of the VIX index can also be expressed as a 50-day average. Here, too, the same picture emerges. The skew index measures the cost of hedging a portfolio using put options. Investors always try to hedge, but they do so more as a precaution. If the ratio between the skew and VIX index falls into negative territory, this is no longer the case. Then investors are willing to pay a high premium for hedging their portfolios. They usually only do this when emotions are particularly high. By the time everyone has become fearful, they have usually sold their positions. This reduces the selling pressure and makes it easier for the bulls to stage a counter-movement. The general sentiment indicator takes even more inputs into account when defining the current sentiment. This has now also reached a level that usually brings a short-term, technical recovery. Conclusion: Wall Street will continue to face massive bear pressure in the new week. Short-term sentiment has already reached a very pessimistic level. It would therefore not be surprising if a stronger recovery were to occur soon. However, if we look at the sentiment indicators from a longer-term perspective, a change in sentiment is only just becoming apparent. The bears are therefore likely to continue to have their way for a little longer. Remember that these thoughts are not investment recommendations, but only our opinion. For recommendations, contact your own investment advisor. And thank you for watching this episode. I hope I was able to give you a few good thoughts for your investments. Don't forget to give us a thumbs up below to help us keep creating this great content for you. And don't forget, if you register directly on our Substack website, you will receive my next thoughts at least one day earlier. Check out the Substack link in the description, and best of all, it's free. I wish you great success with your investments and see you for our next market update.